Hi, I'm James, and I've been a fund manager for about 22 years, and I've got this week's update for you on video. So have a look at it, see what you think, and please leave some comments below if you've got any questions or anything you'd like to add. That'd be fantastic, and I'll see you in the video. Take care. So let's have a look at the charts, and I've got a number of charts up here. We'll go through them quite quickly. We've got the euro against the dollar, all against the dollar, the pound against the dollar. We've got gold, we've got the Australian dollar against the Japanese yen, slightly different, NASDAQ, and the dollar index. The most pertinent one to all of these is the dollar index, because this will dictate what's going to happen to most of the market, including stocks. So let's have a look at what's going on with the dollar index. And you can see at the moment, I've got the 1473 stochastic on. We've been in a prolonged oversold period for quite a long time, since the middle of last month. So we're heading on towards a month of being oversold on the dollar index. That's quite a long period of time. If you look back in the charts going back throughout the year and prior to that, any period of time you care to look at, you can see the dollar index, or any chart for that matter, tends to be overbought or oversold for brief periods of time. On this occasion, we've been oversold for about a month, and there have been occasions there was an overbought period for about a month and a half over there, but mostly we touch these areas and we move back. That's going below 20 for oversold, above 80 for overbought, and we've been oversold for quite a long period. Let's have a look at what's actually going on the real price chart, indicators aside. Remember that indicators are just, that's what the name is, indicator. They don't dictate the market direction. They don't tell you what's going to happen. They're not predictive. They're actually retrospective. They look back at what's happened and tell you what's happened. That's all. They don't really tell you what's going to happen in the future, although they can be indicators of such. So we've reached this really important level, not quite, but almost, at about 103.70. Well, it's between 103.50 and 103.80. We've held above there multiple occasions. We've been going sideways for a week and a bit. Crucially, though, we're below all of these moving averages. So this green line here is the 20-day moving average. This is the 200-day moving average, and we're below that, which is a little bit bearish, actually rather bearish. And of course, we've got the 50 and the 100 way above us. So what's going to happen next is very difficult to say, and this is going to be really important for the markets going forward. Bear in mind, we're at key support. We've been oversold for a long time. We're below the moving averages. There's room for a bounce back up to this red line. That's 107.50 or so, perhaps even higher, back up to these moving averages, the 50 and the 100, in a sort of a mean regression move. You can see, looking back over time, that the 50 and the 100 period moving average actually often act as a magnet for the dollar index, and we don't stray too far away from those moving averages for too long. We're quite a long way from them at the moment. So there's definitely room to retrace back upwards, but overall bearish. And that's caveated by the fact that we're at support, pretty key support, and we don't know what's going to happen next in the markets. We're at a very crucial level. Now, what's going to happen on Wednesday this week coming? It's Sunday today. On Wednesday, we're getting the CPI data from the US, and we're also getting the Fed FOMC interest rate hike decision. Those are going to be two very crucial numbers that come out. I think it's actually Tuesday for the CPI, and Wednesday, I haven't actually to be honest, had a close look at it, but it's around about Wednesday. Both of those numbers come out one day after the other. So having said all of that, let's have a look at the euro and see what we can glean from the individual charts. Euro's pretty much overbought as well. You can see euro moves pretty much in tandem with the dollar index, overbought on the stochastic. And also, we're just not getting above this reversal level. Now, remember last week, we had this opportunity to sell the euro and gold and the pound and NASDAQ. We sold all of those last week for a nice move down, but we've bounced back up a little bit. We're still holding beneath that bearish engulfing candle. Now, go and have a look at my videos on this channel about candlestick patterns. I'm putting together a series. The first one's out. Subscribe to this channel and press the like button, press the notification bell. Do that right now, and you'll get those videos as soon as they come out. So that's really important. And we spotted some of these candles last week, which was really profitable for us. We spotted this hanging man candle on the euro. That was followed by a bearish engulfing candle with a spike high, very bearish, overbought stochastic, all those sorts of things going on at the same time. And at a pretty crucial level. This level here, where the green starts flowing into the pink, is the, let me just make sure this is right, the 38% retracement of the move down from all the way down from here down to where we are at the moment. So that's a 38% retracement level. We touched it perfectly and beautifully. It's a previous resistance level formed by this head and shoulders region. We're above the 200 moving average, but overall, we're starting to see some faltering and some weakness in the euro. We still haven't actually invalidated that pattern, and so there's plenty of space for the euro to move down. We're short the euro going into the coming week and going into FOMC and CPI. Same sort of thing on the pound. It's not quite as clear, but having said that, it's a pretty similar pattern. Look at how overbought we are on the stochastic. We're against this Fibonacci level. That's the 50% retracement, not the 38.2% retracement. That's the 50% retracement. So the pound's moved up a lot. It's been very bullish against most currencies. Most British pound pairs have been bullish. So that huge move down to that big spike low when the pound collapsed briefly, we've now retraced half of that move. Can you believe that? We've moved up from 1.04 to 1.2260. That's a massive move higher in the pound. It's pretty overbought. We've reached key resistance level, a key resistance level here, very, very key, that little double top, 50% retracement, overbought in the stochastic. And then if we have a look more closely at the candles, you can see a pretty similar pattern to the euro. We had that hanging man followed by a bearish engulfing candle. We've edged up very unconvincingly, and on Friday this week we formed a spike high, a potential reversal. We're short the pound going into the coming week. Doesn't mean we're going to be right on this, of course. Anything can happen, and a lot depends on what the dollar index does. So remember to always have stop losses in place and trade carefully, and don't put too much emphasis on being right. Just make sure that if you're wrong, you get out of the market quickly. Gold, same sort of thing. Now, we were bearish gold. That worked out really well based on, again, the hanging man. And now we got this big bearish candle. We're edging back up towards those highs. Friday closed with a bearish reversal candle again against that green line, which is a key resistance level just above $1,800 on gold. Stochastic divergence. We talked about the divergence on the stochastic before. You can see the stochastic's moving down. The price has been moving up. Stochastic divergence, bearish reversal candles all over the show. Hanging man, big bearish candle, spike high on Friday, key resistance level. And however, having said that, we are supported by the 20-day moving average. We're short gold going into the coming week. Now, this is an interesting one. Go and have a look on my Twitter feed. And again, please follow me on Twitter. This here is called a king's crown. Now, I've drawn a few little extra lines in here, but this zigzag pattern based on this trend line and the patterns that we're seeing here, we sort of zigzag above a trend line. We form a final gasp high, break down through that trend line, that's this green line, down to the moving average, and bounce back up again to the underside of the trend line, and then begin to move down, a little bit of retracement, and then the next move down in this pattern if it works out perfectly. And remember, they seldom work out perfectly in any sorts of markets, particularly in currency trading. But having said all of that, it's pretty interesting. The only caveat to all of this is we're actually oversold on the stochastic. So we'd like to see a little bit of pullback of the stochastic into at least the mid area, the 50 region, and then perhaps potentially a wee bit higher on this, and then this move down to complete this King's Crown pattern. Go and Google King's Crown or Crown pattern and try and see how that fits in. So basically we want a sort of a crown looking pattern. It doesn't have to be perfect, but we want to see it forming around a trend line which eventually breaks. That's the key part of this. Trend line breaks, we retrace back to the underside of the trend line to form that last sort of spike on the crown, and then we begin to zigzag lower. That's euro yen, we're short. Aussie dollar yen, we're short. Aussie dollar yen. Lots of shorts this week. Now, Nasdaq's interesting. I really don't know how to deal with this, but I can tell you what I think. So on Thursday, we had the jobs numbers. They came out pretty good. A little bit of an increase in jobless claims, but not really very much. Surprisingly strong in the job market, I would say, even though it did weaken a little bit. So that was the Thursday news. Market sort of didn't do much. That was this candle here. Actually, the market rallied a bit because the jobs were a little bit weaker, but not much. So that gave a little bit of boost to this market because bad news is good news. Remember that in the current market with interest rates and CPI and all that sort of thing. And then on Friday, we got we got the PPI number, which is the producer price index, which is a precursor to the consumer price index, and that actually went up quite significantly compared to what was expected. Slightly down overall, but kind of hot, kind of a strong number, a high number, which has given some jitters in the market. Now, what happened on Friday? I haven't got the hour chart in here, but you can go and have a look at your short-term hour chart or 15-minute chart. You'll see the market, first of all, plunged downwards on the strong PPI. Negative for the market because that means that interest rate hikes might continue at a fairly rapid pace or more rapid than was expected. And then the market thought, well, actually, the number's not that bad. And the market began to rally up to a higher level. And then towards the end of the day, people began to realize that actually the news is pretty bad in terms of producer price increase and index increase. And the market then began to drop. What we have here, ladies and gentlemen, is a rejection of the 20-day moving average and what is called a dark cloud cover candle. This is pretty classic, pretty bearish. Now, the market's expecting a Christmas time rally, which normally happens, I think, something like 7 out of 8 years. Towards this time of the year, the market begins to rally. So everyone's kind of pricing that in as well, thinking, well, we can't go short because the market's going to rally. Then the PPI comes out strong, and everyone's thinking, well, maybe we're not going to get a Christmas rally. I don't know. All I can say is we rejected the 20-day moving average. It's looking weak. It's not managing to get this Christmas rally going at this stage. And we've got this engulfing, bearish engulfing, not engulfing, dark cloud cover candle. Once again, go and have a look at my videos on candle patterns. They're on this channel. There's a whole section on it. There's a couple of videos on there. Started the first one in the new series. And if you click on the like button and subscribe to this channel and press the notification bell, you'll get instant alerts of those videos when they come out. This one, as you will note from some of those videos, is one of my favorite. Dark cloud cover, rejection off the 20-day moving average. Remember, these candle patterns should always be used in conjunction with other things on your charts. And also, not only is that the 20-day moving average that we rejected, it's also this Fibonacci level right here, which is a 38.2% Fibonacci level of this move down from there to there. We got to the 50, dropped below the 38, back up to the 38 and the 20-day moving average, and then dropped back down again. So pretty important. Right, now, that's the NASDAQ. We've talked about the dollar index. We've talked about gold. We've talked about all of it. So that's my strategy going into the week. These are my main trades. I've got a couple of other trades going on other currencies and a couple of stocks that I'm looking at as well, including ammonia energy stocks. And believe it or not, I'm looking at ARC-K. So if you'd like more information on all of that, there are links on this YouTube channel to my website. You can sign up for free for 7 days, or even better, join as a member. First 30 days are free, and you'll get all my trades as I take them live, real time. It's all there for you. Go and have a look at it, ArcisFX.com. Take care. Have a fantastic trading week. Good luck and bon chance.